2 of the Substantive Procedures video recorded lecture. I hope you've watched part 1. If you've not watched part 1, then this video recording lecture is not going to be beneficial. And just watching part 1 without also watching part 2 will not be fully beneficial to you. So I recommend that if you've not yet watched part 1, go and watch part 1 and then come back and watch this recording session. Alright, so what are our learning outcomes? Now we want to look at substantive procedures and assertions. In the previous session, we looked at how to formulate a substantive procedure. We looked at how substantive procedures are assisting in obtaining sufficient appropriate audit evidence based on the risks that would have identified at risk assessment. Now we want to see how exactly your substantive procedures are related or linked to the assertions. We're also going to be looking at substantive procedures and the accounting treatment and how that ties together. We'll also then have a short example so that we can attempt to apply the knowledge that we would have gathered. Then we'll also look again at the general auditing procedures. In the previous session, we looked at general auditing procedures, but now we'll be looking at them in a bit more of detail. We also want to understand the requirements around analytical procedures. Okay, so let's start. We've got our assertions. Assertions that relate to account balances and assertions that relate to classes of transactions. And we've also got the assertions that relate to our disclosures. So we're saying, how exactly do the substantive procedures tie together with the assertions? If you remember, if you refer back to your modules, you'll see how many assertions we have, which ones relate to account balances, and which ones relate to classes of transactions. Then we're saying, when we're obtaining audit evidence through substantive procedures, we want to verify, or we want to confirm what management is saying about their financial statements. So if management is saying these financial statements are complete, or this account balance or class of transaction is complete, we will go in there and say, are there any risks in relation to the completeness assertion of this particular account balance or class of transaction? Then we will formulate substantive procedures using how, what, and why, also referring to the nature of substantive procedure. Is it an analytical procedure or is it a test of detail? And the extent to which we're going to be carrying out that particular type of substantive procedure in trying to verify and confirm whether what management is saying in terms of completeness, as I said earlier, is actually true. So that is how the two are linked, the substantive procedures and the assertions. We carry out substantive procedures to confirm the assertions. Then we've got substantive procedures and accounting treatment. Now you remember from earlier sessions where we actually said that the reason why the auditor is going into audit, if you're going to be using an ISA audit, carrying out an ISA audit, it's going to be based on IFRS, for example. And the IFRS, so remember your opinion is saying in all material respects, these financial statements conform to a certain benchmark, and that benchmark could be your accounting standards, which could be, or your accounting framework, which is, let's say, your IFRS. So when you're formulating your substantive procedures, you're testing assertions, and the auditor shall test those based on the accounting treatment of the item. If it's inventory, then you're going to be testing you're carrying out your substantive procedures, testing the assertions that are on inventory, which is your IAS 2 if you're going to be using IFRS. So you need to go back to what is the accounting treatment of inventory. And once you've got the accounting treatment of inventory as per IAS 2, you then know what substantive procedures you need to carry out. Because that accounting treatment is linked to assertions. And we'll just look at what happens. So we've got our IFRS. Our IFRS, let's use IFRS 2 for example. At the beginning of your standard, you've got the scope. The scope actually says what is scoped into IAS 2, what is called inventory. And it also scopes certain things out of IAS 2. So you find that when you look at your scope, that is the classification, that's the assertion. So management is saying that we have called it inventory because it is correctly classified as inventory. It is within the scope of IAS 2. So remember, inventory is an assertion. So we're saying we incurred this, so inventory is an asset. So we're saying we incurred this, it is an asset, and it is inventory under assets. It is not an expense. So it is correctly classified as inventory. Then we go on to the accounting treatment. Once you've got the scope, you go on to recognition. And with recognition, what assertion is linked to recognition? So we're saying if you've got inventory, as we said, we'll be using the example of IAS 2. Did it occur? So it has to be recognized first and foremost if it occurred. If it did not occur, then you do not recognize it. Did this transaction occur? So therefore, it falls under, it can then be recognized. Do we have rights over this inventory? If we do, then it can be recognized. Or if it's an obligation, it's a liability, then you can only recognize it when you say that there is an obligation. We also recognize it when it is complete. Should everything that should be included in recognizing for inventory. So it could be your costs that are capitalized to inventory. Maybe your cost of bringing that inventory item to where it is. Your cost of maybe duty if it's imported. That then says it should be included in inventory. So therefore, inventory is complete with this. If it shouldn't be in inventory, then inventory is not complete when it has things that shouldn't be in it or expenses that shouldn't be in it. So it is what? Scoped out, and so it is also not recognized. For example, your VAT. Your VAT should not be recognized as part of the cost of inventory. So it is what? It is out. But your transportation cost is in. So it should be included as your cost of VAT, as your cost of inventory. Therefore, it is recognized. And also, something is recognized if it exists. Your inventory will be recognized if it exists. So those are the assertions that deal with recognition. After you've recognized, we are also saying, let us classify it. Is it correctly classified as inventory? Therefore, we've got the assertion to say it is what? Correctly classified. We've got the classification assertion. It is not anything else. It is inventory. Therefore, it is correctly classified. Once we've ticked scope, we've ticked recognition, we've ticked classification, we move on to initial measurement. At what amount are we going to be measuring? And that's when your valuation and accuracy assertions come in. And remember, I'm dealing with all the assertions as much as maybe accuracy does not relate to account balances, which maybe if we're dealing with our closing inventory, which is an account balance. But I'm going to be dealing with all assertions. So accuracy would be maybe when we actually acquired the transaction to acquire inventory, which is our purchases. Did we record this transaction accurately? If we recorded it accurately, then it's also at initial measurement when it comes to accounting standards. Then we've got our subsequent measurement. Now that we've recognized initially, you know, we've got things like impairment, we've got things like maybe depreciation, we've got anything else that we might want to include as subsequent measurement. That will then also speak to your valuation accession, because at subsequent measurement, we still need to confirm, is it correctly valued? Is it accurately? Is it accurate? Is the transaction accurate? So maybe if it's PPE, would need to depreciate. So did we accurately depreciate? Or even if it's inventory and it's no longer, remember, inventory has to be carried at the higher of, at the lower of cost or net realizable value. The lower of cost and net realizable value. Then you realize that maybe we were recording at cost, but now net realizable value is lower than cost. So we're saying, have we then accurately taken that into consideration? Have we accurately impaired that inventory? That transaction of impairing, is it accurate? And has it been done at the correct amount? Then we've got rights. Subsequent measurement is saying, do we still have rights to this? And is it there? Is it existing? Therefore, occurrence. Disclosure. You find that your disclosure and presentation, those are our sessions for disclosures and presentations, all those are sessions that relate to disclosures and presentation, will then tie up with the disclosure that you're going to make on inventory or on IFRS 9, any other accounting standard. Then when we dispose of that inventory or we dispose of a financial instrument, then we're saying we de-recognize. And again, we go back to rights. Do we still have the rights? Is it still existing? And the answer will be no, because we've de-recognized. So that is the link between your assertions and your accounting treatment. So when you're formulating your substantive procedures, you then need to say, where exactly is my risk? Is my risk under initial measurement? So which assertions are dealing with the initial measurement? And that could be your valuation, or it could be your accuracy. Then you formulate your substantive procedures to test for valuation. You formulate your substantive procedures to test for accuracy, so that you can gain comfort over the initial measurement to say this asset or this liability was actually initially measured at the correct amount. It can also be a class of transaction that you're testing to say, was it initially measured at the correct amount? Let's apply the knowledge that we've gathered so far. Some might still be confused to say, what exactly is Nyasha trying to say? Let's apply the knowledge. We've got an example, and this example is on treasury bills. Let's read it. So Zimbabwe Foods supplies inputs worth $1.5 million to farmers across Zimbabwe. And this amount was settled by government by issuing treasury bills to Zim Foods with a nominal redemption value of 1.5 million, carrying an annual coupon of 5% as full and final settlements of the amounts owed. Zim Foods accepted this offer in January 2019, and management have indicated that they intend to hold these treasury bills up until maturity, which is in 10 years' time. So this is our mini scenario. Let's see how then will we formulate substantive procedures. How then will this be linked with risk assessment and the assertions? So this is a treasury bill. and Zim Foods wants to recognize this treasury bill. But it's going to recognize it. First and foremost, it has to determine which standard is it going to fall under. And one would say IFRS 9. But is it really a financial instrument? You then have to ask yourself, I'm applying IFRS 9 accounting requirements to the treasury bill. So IFRS 9 specifically excludes IFRS 2, 16 or IAS 19, for example. So remember, we're scoping in, does this treasury bill fall under IFRS 9? We go to, if yes, so it is classified. Is it correctly classified? Then we need to then say, if it is correctly classified, what's the value, which is valuation, and did we value accurately, which is the accuracy assertion. Remember, you're saying, just classifying it, or just saying, is it falling under IFRS 9? It's a risk. If this does not fall, if this treasury bill does not fall under IFRS 9, then it's something that can possibly go wrong. So you then want to go and formulate substantive procedures to say, has this been correctly classified under IFRS 9? Is this treasury bill truly a financial instrument? So how are you going to do that? Maybe you're going to be inspecting the contract, inspecting what, the contract, why, to confirm certain terms of the contract, which will then scope the treasury bill into IFRS 9. So that would be your substantive procedure. Then let's go on to initial recognition. But when we're initially recognizing this treasury bill, what can possibly go wrong? So recognizing the financial instrument before or after Zim Foods has become part of the, or a part to the contractual provisions of the instrument. So we're saying, what can go wrong at initial measurement? One could initially measure before this financial instrument or this treasury bill is in the hands of Zim Foods, or maybe way after. So we're saying there is a risk there. So we need to carry out or formulate substantive procedures that will then tell us whether the initial recognition was actually done at the correct point in time. So the correct time is when Zim Foods become part of this transaction. So they recognized it. Initial recognition, they've recognized. So the client has recognized using a particular date. Your substantive procedure now, because you're saying what can go wrong, what can go wrong is premature, for example, recognition. So we're saying when, on what date have they recognized in their financial statements or in their accounting records? And then we go and say, let's obtain the contract and let's inspect it for the date on which Zim Foods entered or signed this particular contract or agreement. Why are we doing that? To confirm that Zim Foods became a part to this transaction, or to confirm that it is in the name of Zim Foods. At that particular date, what exactly are we inspecting on this contract? We're inspecting for the date, because the date will allow us to say, is the initial date of recognition correct? Okay. Then we move on to, let's say, initial classification. So incorrect, what can possibly go wrong? Incorrect classification of the instrument. For example, somebody can classify this financial instrument as, let's say, a financial asset through profit or loss, or a financial asset through other comprehensive income. So again, what assertions are affected? Classification, because you're classifying it under the correct class of financial instruments. But that could be a risk. So formulate substantive procedures that will confirm whether it has been correctly classified under the correct class of financial instruments. You're also saying, has it been accurately classified and was the transaction accurately recorded, as well as the valuation. Is the valuation correct? You can also go on to initial measurement. Initial measurement is what can possibly go wrong when you're trying to measure initially. So that the treasury bills might not be initially measured at fair value, or might not be initially measured at what? At amortization cost. So maybe that is what it should be, at amortized cost, sorry. Maybe that is what it should be measured at, fair value or amortized cost. That's something that can possibly go wrong. But what assertions are affected if this, which can possibly go wrong, goes wrong? Valuation and accuracy. That is what can possibly go wrong. Subsequent measurement. Again, you're asking yourself, what can possibly go wrong at subsequent measurement? So the treasury bills might not be subsequently measured at amortized costs using the correct effective interest rate. So that would affect your valuation assertion. And so you might actually want to then carry out substantive procedures over that. Disclosures, incorrect disclosures of the treasury bill. What assertions? Disclosure and presentation. Derecognition. We might fail to derecognize the treasury bill when Zim Foods is no longer a part of the contractual provisions. And so that could also affect your rights and existence. Then we've got our general procedures. These are recalculating castings and calculations, agreeing opening balances, let's say to prior year financial statements or to prior year working papers. We've also got agreeing certain information to the ledgers. The subsidiary ledger agreeing, is that same amount that is recognized in the subsidiary ledger, is it also the amount that was recognized in the general ledger? We also want to agree totals. For example, saying, is the age analysis, is it the total on the age analysis, is it the same total that is also on the list of creditors, and you're agreeing that, let's say, with the general ledger account. You could also agree the general ledger balance for a class of transaction, let's say for inventory, to the trial balance, to the annual financial statements. We could also have inspection of minutes of meetings. That could also be a general procedure. Okay. Then lastly, we've got our analytical procedures. So our analytical procedures, again, remember, as we said in the past, these could be dealing with trends, expected trends. It could be a relationship, an expected relationship between financial and non-financial information. So we need to then investigate any fluctuations or any non-conformities to the relationships that we know. Those are your analytical procedures. Excuse me. Then we've got the nature of analytical procedures. It could be comparisons, where you're comparing information to prior periods, where you're comparing with anticipated results or similar industry information. It could be consideration of relationships between elements of financial statements, your sales and your gross profit, financial information and non-financial information, the cost versus the number of items. That could also be your nature of substantive procedures. So an example of a substantive analytical procedure would be compare the current year balance to the prior year listing. It could be for, let's say, creditors in the prior year and creditors in the current year. You could also want to calculate the percentage increase in, let's say, revenue and compare it with industry averages. Does it make sense? The moment it does not make sense, then you need to carry out test of details. But already, if it makes sense, that's already testing as a substantive procedure. Which IFRS standards are we going to be using or examining? In semester 1, you refer to your financial reporting modules. All the financial reporting standards that you have learned in semester 1 will be examined or can be examined under substantive procedures. What is it that we should do going forward? So please make sure you go to your modules, read course notes on risk assessment, read course notes again on substantive procedures thereafter. If you've already read on risk assessment, then just go on to substantive procedures. Attempt the online quiz that you're going to be given on a date to be notified. Attempt the practice questions in your modules. If you identify that you're facing challenges, book a consultation, a physical consultation or the WhatsApp consultation, and communicate with us. Our contact details of the department are as you see listed there, and the auditing department email. Thank you very much for being with me in this session. I look forward to seeing you in next sessions.